In this week's video, we'll review the latest charts in the context of stock market history to help us answer the question: if the market backtracks, how far could stocks fall? Let's quickly review what we covered just 3 short weeks ago, and that was that the bearish case, for the most part, is easy to understand. We've got a global pandemic, social distancing, no vaccine, a global economic shutdown, with numerous challenges trying to come out of that shutdown. And thus it's widely understood and accepted that a big hit to both earnings and GDP is right around the corner. Everything that we've done in recent weeks and everything that we will do in this week's video helps us assess the probabilities related to scenarios 1 through 4. The bullish case is still harder to understand, comprehend, and respect in the present day relative to the bearish case. Since the weight of the evidence builds over time, let's review some of the studies that we've covered in recent weeks. April 14th, short takes. This breadth study told us to keep an open mind about much better than expected outcomes, and to have realistic expectations about 100% normal and to be expected drawdowns walking forward, even if things unfold in a bullish manner. Just as a quick reminder, this is not just a graph or lines on a page. Charts and the relative performance of asset classes are a reflection of human behavior. And as we noted on April 17th with this study, when human beings acted in a similar manner in the past, really good things happened in the SP 500 walking forward 2 weeks to 5 years from the date of that signal. This study was based on the NASDAQ 100 Bullish Percent Index. This study presented on April 17th is based on the NASDAQ percent of stocks above their 200-day moving average. In the Friday, May 1st video, we covered this NYSE Bullish Percent Index chart and noted that it aligned with the concept that markets tend to do best when the economic and macro data is going from really bad to less bad, really bad to less bad, really bad to less bad. And when human beings acted in a similar way in the past, markets experienced 100% normal and to be expected volatility looking out 2 weeks to 2 months, but the returns looking out 3 months to 5 years, in every case the market was higher. And understanding all of this helps us respect and prepare for the bullish case walking forward. It does not negate our respect and preparation for bearish outcomes. It's a weight of the evidence approach. May 1st, basic materials. This is a shift in human behavior. This is a shift in their perception of future economic outcomes, an extremely rare shift. It only occurred 2 times in the last 20 years, April of 2009 and April of 2020. Also noteworthy, this shift occurred in highly economically sensitive basic materials. NYSE stocks above their 200-day exponential moving average from the May 1st video. This shift in human behavior only occurred 2 previous times dating back to the 1980s. This one occurred after the 1987 crash, after the final low was in. And this one occurred after the financial crisis bear market and after the final low was in, simply helping us keep an open mind about better than expected outcomes. This is not just a bunch of lines on a page. It speaks to all of this. Only 2 times in the last 38 years has the extremely broad value line geometric index seen a move like this. One occurred in April of 2020. The other one occurred in April of 2009 after the major low in the S&P 500 that was printed on March 9th of 2009. Again, you have to think about what this means. This is defensive bonds relative to growth-oriented stocks. This is an extremely rare shift. Dating back to 2007, Only 2 times. First time April of 2009, second time April of 2020. A weight of the evidence approach, which speaks to probabilities. May 1st video, NASDAQ stocks above the 50-day exponential moving average. Something that just happened. Human behavior, a shift in human behavior, happened after the low, 2018, after the final low was made in early February of 2016, and after the low in March of 2009. And if you're a client, it's extremely important to keep in mind that 3 of these 4 cases are either neutral or bullish. How can a typical retest of the March 23rd low be bullish? A retest basically says you're going down near the low and then you will march higher. Wouldn't be shocking at all if the market decided to backtrack. We just reviewed a very small sample of the hard data that we've reviewed in recent weeks that tell us to keep an open mind about better than expected outcomes. Is there anything else, anything based on hard data that has nothing to do with our personal opinions that can help us combat all of the negativity in the present day? The answer is yes. And keep in mind, it's a weight of the evidence approach. The new signals build on the old signals. New indicators and new signals. S&P 100% above the 150-day moving average. It's extremely rare to see this indicator move from the bottom blue line, rarely oversold, and get back to this point here. And to do so at a very rapid rate. Looking back to the year 2000, it's only occurred 2 other times. Rate of change spike here, similar. Rate of change spike here, similar to this point here. This move here is similar to this move here, and this move here is similar to this move here. Therefore, it might be helpful to know, after a very similar shift in human behavior, how did stocks perform walking forward? The answer? Extremely well. 100% of the cases higher. 6 months out to 5 years out, 2 weeks to 3 months, 100% normal and to be expected volatility. November 7th of 2002 is similar to the present day. April 16th, 2009 is similar to the present day. Maximum 6-month drawdown in the O2 case, 11.29%. In the April 2009 case, 3.8%. Helping us keep realistic expectations about how markets operate in the real world, even under a bullish scenario. And we're not making any assumptions that that's the case. This just happened. When it happened in the past, good things happen walking forward, which doesn't mean the stock market goes up every day. If we can get signals on multiple indices, that speaks to the weight of the evidence, and that speaks to a broad rally. This study was based on the S&P 100 index. This study is based on the broader SP 500 index, percent of S&P 500 stocks above the 150-day moving average. Present day, similar to January of 2019, October 2011, April of 2009, and November of 2002. How did stocks perform walking forward in the similar historical cases? The answer is extremely well. 100% of the cases were higher 6 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. Wasn't necessarily a walk in the volatility park from these dates. Average drawdown, almost 6%. Median drawdown, roughly 5%. Maximum drawdown, 11.29%. These numbers here, relative to these numbers over here on the right side of the screen where my cursor is, tells us unless something changes in the data walking forward, and that's quite possible, the risk-reward ratio for these 100% normal and to be expected pullbacks could be excellent. There's no free lunch in the stock market. To get all the way out here, you had to withstand this in the next 6 months. It's a narrow rally. This is the S&P 100. Just covered the S&P 500. Weight of the evidence approach, NASDAQ 100% above the 150-day moving average. Present day move here is similar to the move in February of 2019, October of 2011, April of 2009, and November of 2002. After similar and rare shifts in human behavior, good things happen for a long period of time. 100% of the cases higher between 6 months out and 5 years out. And all of this helps us with the realistic expectation department. To get out here, the average drawdown 6%, median drawdown 6%, maximum drawdown double digits at 11.29. But this was followed by this. Now we're going to shift gears to the CCM Friday Blitz portion of the video. Feel free to use the pause button on your video player. Let's quickly review some facts that can help us assess odds relative to the 4 scenarios. Focus on the purple boxes here. Tied to the S&P 100 index, tied to November of 2002. The November of 2002 case is before the retest, and we have a fairly significant drawdown of 11.29%. Everything that we just said about the S&P 100 analysis applies to this S&P 500 analysis, including the date and the drawdown. Same thing for the NASDAQ 100. Present day, something that just happened, is tied to November 7th of 2002. And that would be after the major low, but we haven't yet had the retest with a fairly significant drawdown. From the fine folks at Sentiment Trader, you can pause your video player. Here is hard data that also ties the present day to November of 2002. Calculating drawdowns helps us understand 100% normal and to be expected volatility. These are recent drawdowns based on recent studies that we've performed. In the present day, if the S&P 500 fell from the recent closing high, this is what these drawdowns would look like on a chart. If the market backtracks and stays in this range, it's basically staying within bullish historical bounds. Within this range here, historically, if you thought long term, after the drawdown here in 2002, you were rewarded in a big way relative to where my cursor is. The data that we have in hand today, as it sits today, is telling us to try to focus on longer term time frames until the data changes and tells us something different. Even if really good things happen, this is still important if we hope to ride through something like this to get to the other side. Another relevant question, do we have 2020 data in hand that aligns with the 2002-2003 after the low and after the retest scenario? The answer is yes. We'll be moving quickly. April 17th. Tied it to June 6th of 2003. Follow the arrow. May 1st, NYSE Bullish Percent Index, tied it to 2003, after the low and after the retest. We just covered the RIDEX ratio, tied the present day, something that just happened that we can see, measure, and put in a model, to 2003, which is after the major low and after the retest. NYSE percent above the 50-day moving average ties the present day to 2003 in May, after the major low in 2002 and after the retest. And in this case here, which is similar to this point here, really good things happen for a long period of time. Anything else that can possibly help us discern between the spring of 2003, after the low, after the retest, and November of 2002, which is after the major low but before the retest, meaning a significant drawdown was in play? Let's examine a shift in volatility expectations, compare 2002, 2003, and the present day and see what we can learn. This is the old VIX. Why the old VIX? Because we have data going back further. 42-day rate of change. Why 42 days? In the present day, it's been 42 trading days since the low. 42-day rate of change in November of 2002. The lowest reading that we got was almost 40%, 39.69. This is what we would expect to see during a bottoming process. What did this number look like in the spring, after the major low was in place and after or during the retest? Lower means less concern about future volatility relative to this period here. Therefore, in the present day, if we look at the same rate of change, does it look more like November of 2002 or more like May of 2003? The answer is May of 2020 looks a lot more like May of 2003 relative to November of 2002. This is an extremely rare collapse, rapid collapse in volatility expectations. If we simply look at the level of VXO, they're all in the same neighborhood where the purple line is drawn, around 27-ish. You can probably surmise that this is a rare figure here on the right side of the screen in May of 2020. Therefore, it's logical to ask, are there any other points in stock market history that featured a similar rapid drop in volatility expectations? To answer that question, we have data for VXO going all the way back to 1986. Have we ever seen anything similar to this number here? If so, how many times? The answer is yes. There's only one period in the entire history of VXO that looks even remotely close to May 18th of 2020. And that's this gigantic spike that happened during the 1987 crash, and this point right here. This point right here is similar to May 18th of 2020. This day here is December 23rd, 1987. Thus, the million-dollar question: did the similar rapid drop in volatility expectations come before the low and or the retest, or after the low and or retest? If you know your market history, you know the answer. December 23rd, 1987 is after both the major low and the retest of the low. Since December 23rd, similar to May 18th, it's logical to ask, what happened walking forward from December 23rd, 1987? The answer is really, really good things happened. Order of magnitude of 45.36%. Market rallied from December 23rd all the way into calendar year 1990. And given the fact that this is extremely rare, only happened one other time in the last 35 years, it may not be shocking to learn that from December 23rd, 1987, really, really, really good things happened for a long period of time. Stock market basically never looked back from December 23rd, 1987. We've never revisited this level. How about volatility expectations this week relative to last week? Now let's shift gears to the present day VIX, or the symbol VIX. Everything that we said about this chart a week ago, which was, it's not particularly alarming. Friday, May 15th, during that week, the S&P on Tuesday was down 1%. On Thursday, it was down 0.78%. Did we get a big and concerning spike in the VIX when we looked at it at 3:11 Eastern Time on May 15th? No. As we said last week, this looked relatively tame. Market's been volatile again this week. How does it look a week later? Better, worse, or about the same? The answer is better. The VIX is even lower, which means everything that we said about the chart last week applies to the chart this week. When we talked about the VIX on May 15th relative to the close on May 15th, the VIX dropped 10.25% this week. And that speaks to volatility expectations looking out 30 days for market participants. If market participants believed that a big drop was coming in the S&P 500, we would expect the VIX to be up double digits this week, not down double digits. If market participants believed that a big spike in volatility was coming and or a big drop in the S&P 500, we would expect TLT to attract interest. TLT down 0.8% as of 1:28 p.m. for the week on Friday, May 22nd. This doesn't look like a maximum fear trade, and this doesn't look like a maximum fear week. And how about price, the S&P 500 itself? Sometimes volatility over the past 2 or 3 days makes it easy to forget that this week, as of 2:30 p.m. Eastern Time on Friday, the S&P was up 3.09% for the week. And now back to our regularly scheduled programming. You may say, we don't need all these indicators. Price is king. That's all I need. Well, we've got something for you too. This is basically 100% based on price. Only 3 times in the last 70 years has the 41-day rate of change in the S&P 500 looked like this. Why 41 days? It's been 41 trading days since the March 23rd low, and that's as of May 20th. It's 100% rational to want to know how human beings reacted after a major low was in place. The reaction walking forward from the May 23rd, 2020 low is very, very similar to the reaction after the March 2009 low, and very, very similar to the rally that started in July of 1982. Notice the rate of change only hits the blue line in the present day, May of 2009 and October of 1982. We don't see it happening anywhere going all the way back to 1950. Once again, this is not a line on the chart. This is the net aggregate opinion of all market participants regarding all subjects on all time frames, making an incredibly rare and rapid shift, only seen 2 previous times in the last 70 years. And you may say, well, Chris, May of 2020 is nothing like May of 2009 or October of 1982. Sentiment in the present day and the economic outlook in the present day is much worse than it was here and here. Well, if you're aware of economic and market history in this period here, and if you're aware of economic and market history in this period here, you know that sentiment was horrible and the economic outlook was equally horrible. This Business Week cover here, August 13th, 1979, The Death of Equities. Here's the quote. For better or worse, then, the U.S. economy probably has to regard the death of equities as a near permanent condition. And you may say, well, August 13th of 1979 is a long way from 1982. Sentiment is terrible on August 13th, 1979. Guess where the stock market went between the publication of this Business Week magazine here and July 31st, 1982, where this secular trend started? Absolutely, positively nowhere. It went completely sideways. So you can make an argument, if sentiment was bad on August 13th, 1979, probably worse on July 31st, 1982. Here's another failed rally. It happened again. And this quote here from 2009 would fit very, very well with the present day. Despite the aggressive action from the Fed, the economic outlook would remain weak for a time, and the downside risk to economic activity would be substantial. This comes straight from a Fed document in Q1 of 2009. Sounds familiar? So the economic outlook is horrible here. Sentiment's terrible here. Economic outlook not favorable here. Sentiment terrible. What happened walking forward? The answer is really good things happen for a long, long period of time. We didn't arbitrarily choose October 8th, 1982. We didn't arbitrarily choose May 8th of 2009. The hard data chose May 8th, 2009, October 8th, 1982. We didn't arbitrarily choose 41 trading days. It's very logical. It's been 41 trading days since the low. We want to know how human beings have acted and shifted, what bets they've made, relative to their expectations of future economic outcomes since the low. That's what this tells us. That's what this tells us. And that's what this tells us. Only 3 times in the last 70 years. 2 previous times, outlook sentiment terrible. Sound familiar? Subsequent market performance walking forward simply tells us to keep an open mind about better than expected outcomes. That's it. It helps us trade the chart in front of us with an open mind. Anything else that can help us assess the probability of scenarios 1, 2, and 3 relative to scenario 4. This is a chart of the VIX relative to the 3-month VIX. We're basically looking at 1-month volatility expectations relative to 3-month volatility expectations. Relatively rare move here. Only happened a handful of times. We really don't even need the rate of change indicator. We can see it right here on the graph. This shift in expectations is similar to this shift, this one, this one, this one, and this one. And in each case, that occurred near a low, after a low, or during a bottoming process. And soon thereafter, or immediately thereafter, good things happen for a long period of time in the S&P 500. In this case, the low was not in, which helps us understand that a bottoming process or even a retest of the low could end up being wildly bullish in the subsequent weeks, months, and years. Is it really a narrow rally only being led by the NASDAQ 100 or QQQ? This is consumer discretionary stocks, XLY relative to SPY. It bottomed before the S&P 500 bottomed, which is right here where my cursor is, and it has been outperforming significantly since the S&P 500 made that low. What does that tell you about the expectations of future economic outcomes? Now, Chris, you're cherry picking one ETF. Thus, let's go beyond one ETF. Since the March 23, 2020 low, is leadership resigned to growth stocks, the NASDAQ 100, and FANG? The answer is no. Economically sensitive, home construction, energy, retail, mid-cap growth, materials, equal weight tech. That means much broader than the NASDAQ 100 and FANG. Equal weight S&P 500 speaks to a broader rally. Broad market ETF, total stock market ETF, all of them have outperformed SPY since the March 23rd low. What does this say about the net aggregate opinion of all market participants regarding all subjects on all time frames, and more specifically, the net aggregate opinion relative to future economic outcomes? None of this predicts anything. It simply helps us assess probabilities. But Chris, the Dow is a big laggard. Nothing good's happening on the Dow. The Dow has been a big laggard, and that is a concern. However, we are starting to see some good things on the Dow as well. You can pause your video player, read this little blurb here, but this is basically a breadth indicator based on the 50-day moving average of all of the Dow components. A move like this is rare, only happened near the low in 2009, after the flash crash, after the low was in 2011, during the bottoming process in 15-16 and in 18-19. If you know your market history, these are basically excellent longer-term entry points. Anything else? Yes, and once again, it's very, very easy to understand how this is not just a bunch of lines on a chart. This is basically the conviction to own bearish bets relative to the conviction to own bullish bets. The stock market bottomed roughly 9 weeks ago. Didn't arbitrarily choose the 9-week rate of change. It's a very logical period to pick. Been a big shift in the bear-bull ratio. A move like this has only occurred a handful of times: 1998, 2003, 2010, 11, 2015, 2016, the present day. If you know your market history, 1998, 2003, after the flash crash and after the European debt crisis, this window here, this is a bottoming process. All of these, from a longer-term perspective, were good entry points, and you can see that. This is the SP 500 here. It's a NASDAQ monthly chart. This candle is in the history books because this is dated April 30th, 2020. This is a wonderful high buying conviction candle here. The conviction look engulfs the conviction of the selling here. This is a sharp reversal in conviction. Similar to this sharp reversal here in 2002, similar to this sharp reversal in 2009, this sharp reversal here, these two candlesticks in 2011. You don't even need to know your market history. You can see good things happen for a long period of time, and good things happen for a long period of time in the three previous cases. This is not two candlesticks. It's a reflection of human behavior. In the midst of a global pandemic, we would think that leisure and entertainment stocks would be dead on arrival. They have been recently. This is a rare shift here taking place. When's the last time we've seen something similar? After the low was in place in 2009. Gold bugs, we need 3 steps for a probabilistic trend change. Step 1, we have to break a downward sloping trend line. We did that right here. Step 2, we need a higher low relative to this low. Step 3, we need to make a higher high. This also speaks to inflation expectations going forward. And it speaks to the expectations of all of that central bank stimulus eventually making its way into the economy. So weekly chart, it's dated May 20th. That's intra-week, hence this caveat here. But we can still learn something. A shift like this, a rare shift in the NYSE, percent above the 50-day moving average, has only occurred 2 other times. April 2009, after the major low. May 5th, 2003, after the major low that was made in October of 2002. Even if this isn't nailed down at the end of the week, the odds say pretty good that eventually it will be nailed down. And if it's not, we still learn something about probabilities. Only 2 previous times, this is all the data that we have. We're not cherry picking the data. It goes back to 2002. Walking forward from this date and this date, which is similar to the present day, really good things happen in the S&P 500 looking out 2 weeks to 5 years. And in this case, the drawdown was relatively muted. But this seems muted. But if we fell 2.82% from the recent high, it would not feel good. It never feels good. All of the drawdowns that we've shown in this week's video simply give us a reference point. Let's assume that in November of 2002, we presented a very, very similar bullish analysis to this week's video. And we say bullish, speaks to bullish probabilities. And then the stock market falls 11.29%, or 9.8%, or 6%. Human nature says we're going to say none of this is right. What this helps us understand is, what's a reasonable drawdown walking forward before we should start getting concerned? These are simply reference points. They can help us assess bullish probabilities and bearish probabilities. And from a risk-reward perspective, if you were able to tolerate, let's say, a 6 to 7% drawdown, the median gain was 68% over the next 5 years from the date of the signal. None of this tells us what's going to happen, but it does help us assess odds of 1, 2, and 3 playing out relative to 4. What is scenario 4? A significantly lower low lies ahead. These odds are not 0. And like everything else, if the data changes in a significant manner, then we have to reassess the probabilities. We have a lot of hard data in hand that tells us to start thinking longer term. 1982, this is a bottoming process type signal. 2009, this is a bottoming process type signal. If you withstood the volatility walking forward from this date here and this date here, really good things happen for a long period of time, and really good things happen for a long period of time. Is there any fundamental data that aligns with a look like this? Yes, but we have to remember the market tends to do best when the economic and macro data is going from really bad to less bad, as we noted on May 1st. Do we have any of that in the present day? Yes, all 50 states are open. It's very, very hard to imagine that the economic data, a broad set of economic data, is not going to improve in the weeks ahead. It's almost impossible for the data to get worse in the short run. You can pause your video player. Wall Street Journal, dated May 21st. Business activity in the US, Europe, and Japan continued to fall in May, though at a slower pace than in prior months, offering early signs that the global economy may have already experienced the worst of the economic damage. Here's the move right here. Really bad to less bad. May 1st, global economy shut down, really bad. May 21st, the global economy was shut down, and now it is starting to open back up. It's quite a bit less bad relative to what we had on May 1st, telling us that for markets, the hurdles that we need to clear are very, very low. How is it possible that something like this could play out in the next few months or the next few years? Repositioning of portfolios, repositioning of conviction. Portfolios right now are positioned extremely defensively. The number 2 overweight of fund managers, cash. Number 3, bonds. They're way underweight equities. 7 of the 8 overweights are defensive in nature. 9 of the 11 underweights are growth related. And the economy is now opening up, and some of the data is already starting to get less bad. Like everything else, we're not predicting how the data will look walking forward. This is something that we can see. If it makes a lower low, then we have to assess that as well. Trade the chart in front of you. How about this argument? The virus is going to come back with a vengeance in the fall, and we are going to make lower lows, and it is going to get worse. That absolutely positively may be the case. But that's a long, long way away. Cold and flu season, basically December 1st to March 31st. From this week, December 1st is 194 calendar days away. March 31st, 286 calendar days away. You can pause your video player here. This is relative to the possibility of having a vaccine in the coming weeks, months, and years. You can pause your video player from Tom McClellan, Twitter handle here. Corporate bond market, less bad. You can pause your video player. Earnings expectations and revisions getting less worse. From Ned Davis Research, here's the Twitter handle where my cursor is here. History shows that the stock market has actually had its best performance in the highest zone of the unemployment rate, the weakest zone of real GDP, and the weakest zone of S&P 500 earnings growth. This is all based on how it works in the real world. And it aligns 100% with the concept that we just need to move from really bad to less bad. May 6, 2020, Germany's reopening offers hope for a semblance of normal life. Really bad to less bad. Carl Quintanilla's Twitter feed, here's his handle here. JP Morgan has a devastating piece arguing that infection rates have declined, not increased, in states where lockdowns have ended. This is not a commentary at all as to what's going to happen walking forward. We're trading the chart in front of us. This is the data that we have now. We'll reassess the data as it comes in from all sources walking forward. And if we need to, we'll reassess the probabilities. And we all know that the only way that we can do that effectively is to head into next week and every week with a flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.